I think we've got a few more people expected, but kick it off. We did get some questions on the Facebook page that we can jump to if we get stuck, but I thought the idea behind taking time out of our nights to do this live is so the people who are here can have a live chat with Tony and have some backwards and forwards rather than reading questions that people posted. So, and I did think it might be a good opportunity to ask Tony to do some live 3-point trend lines with us. He and I tested him sharing his screen the other day, so we kind of worked that out. But does anyone want to start, kick it off, including you, Tony? Do you have anything you want to talk about?
No, I don't think so. What I saw in terms of Accent Group has had some questions about it recently, and I saw that a guy called Brett Blundy retired as a director today. Even though he's still got a big stake in the company, he's not going to be a director anymore, so that would change the score for that company if anyone's been analysing it recently. I started buying some Macquarie Group shares today. I think they're a good buy at the moment. Good article that Steve Mabb shared with us about forecasting and its limitations, along the lines of what we were talking about in the podcast a couple of weeks ago.
That was the Howard Marks one?
Yeah, the Howard Marks one, yeah.
Yeah, a lot of good quotes in that.
Yeah, Howard Marks' latest newsletter was good. I think that's about it.
All right. Anyone want to ask Tony a question?
Oh, good. Back to the bar.
Don't all speak at once. I can see 10 participants. Oh, Angela's there, Dave.
I'll start off, it's okay. My name is Maddie, by the way. I think it's the first time I'm joining the call.
Hey, Maddie.
How's it going?
Good, man.
Good. So I think that probably my question might be contentious about the 3-point trend line. So I think I posted the thing about the SUL the other day, yesterday. I think now it makes sense, but then it's just that I'm trying to figure out that waiting time. If you wait for it for that long period of time, kind of just goes trying to balance that between that waiting time versus buying in the dip. Right? So how do you kind of balance that out? And I think based on the observation yesterday, it just means that the stocks that you could buy now are the ones that have been slowly going up over the last 5 years. But if anything has been steady over the last 5 years, then you kind of will miss out. You'll have to wait for a longer period of time. In the sense that 5 years ago, if it was at a high point and then it has been coming down, the waiting time is longer than actually one that has been climbing up for the last 5 years.
Do you have an example of one that Tony can pull up on his screen and we can have a look at?
So I think SUL was one of them. So I think that's what we were looking at in Facebook, I think, the other day.
SUL?
Yes.
Super Group now, I think it's called. Used to be before though.
Right.
Okay.
So do you remember how to share your screen, Tony?
I'm trying to. Just got to get back into Zoom. I just called a stop.
I can't remember how to do it.
I'm trying now.
More. Oh, share screen. Okay. There you go.
Hey,
that works.
Look at you.
Yeah, so it's a really good question that you asked because particularly in times like now when the market's gone down a lot and it's starting to come back up, the question is, do we wait for the 3-point trend line to give us a buy signal, or do we jump in on the basis of the value is compelling? And I don't think there's any really good answer to that. But I do tend to stick with the 3-point trend line because if take the case of super cheap auto here, even though it's at its low point it was $4.70 and it's now up to $6.77. So you could have made a lot of money by buying it at its low point. But the problem is, how do you pick the low point? If we had a board that, say, on the way down what was the month? At the end of February, it was $8.10, and at the end of March, it was $4.63. So I guess we could have averaged in on the way down, which is entirely appropriate. But I guess also too, bear in mind, like with the GFC, there was another 18 months of dips and rises and bear market rallies and then bear market crashes. And that could be the case with us again. So really, the only reason you wait for the 3-point trend line, which in this case is going to be quite a bit higher than the share price, it's going to be around $9.50, is just to confirm that it's come out of the trough and it's going ahead. You're sort of waiting for all those bumps and jumps and bear market rallies and dead cat bounces to shake themselves out.
So I think this example, and if you compare it to Macquarie Bank, I think this confirmed to me that potentially that 3-point trend line confirms the quality of the stock as well and the sentiment around it, even more because if you look at this one starting from the left-hand side, it already starts at a high point. And it hasn't moved in the last 5 years, it hasn't been doing much movement upwards. Compare that to Macquarie Bank, I think, where 5 years ago it was on the low and it's continuing that trend upwards. So I think that, so if you do the 3-point trend line here, you start from further to the right than to the left starting point rather than.
Yeah, it's a good point. I mean, Macquarie Bank's been in a general uptrend for most of the last 5 years. So I'm prepared to buy that earlier than something like Supercheap, which was in the downtrend going into the COVID crash. So, it may not ever get back to its point, that it was at before the crash, because it was in a downtrend anyway, and it's obviously going to have weak results because of the shutdown. So, it's really trying. The process is really trying to confirm that is something in a downtrend or something in an uptrend. That's really what it's trying to do. And is that sustainable and ongoing?
Yeah.
But look, you raise a good point. I mean, it's something we talked about in the show a couple of weeks ago that, do we buy the banks right now? Because I think that not just Macquarie Bank, but even NAB and AMP and Westpac, which all reported, all have really good results, particularly ANZ. But since that they reported, their stock price has gone down. So I think, I was tempted to buy them because at some stage we'll get really good figures out from companies, and the share price might take a while to rise up to meet our 3-point trend line, and you start to say, well, do I trust the figures or do I trust the sentiment? And we might compromise at that stage. But if you look at the banks back here for this one, ANZ, when it released its results in the last week or so, it was 16.83. It's now 15.56. So if we had bought on the numbers, we would have lost money. So you still, again, this is ANZ as a case of a downtrend that's in effect. So you really do, I guess, it reinforces the point. We really do want to wait for the sentiment to return to that trend line.
So if ANZ or NAB starts picking back up, Tony, then what? Do you look at it again, or do you still hold off?
Well, no. Well, if it starts picking up, but it hasn't reached its 3-point trend line, that's the difficult question. I'd probably wait for it to reach its trend line in this case because they're in a downtrend. But like that again, the buy price for ANZ is going to be, currently it's going to be something around $31 because the line's going to come from there across there over to here. But then as the months roll forward, that peak there will disappear, and then the trend line's going to be from there down to there, and so it's going to be around $26, which is still a long way above $15.50. But those two things will start to meet as time rolls forward, and it might be another 6 months before we decide that the numbers are good and the sentiment is good too. In which case, that buy price line will keep coming down to 22, and then maybe to 20, and the share price will probably rise up to meet it. So that's a solid gold sort of buy signal when that happens.
So I can understand Sorry, Mehdi. I was going to
Okay.
say I can understand Mehdi's view that we're leaving a lot of money on the table there if these stocks, if like say NZ does go from 15 back up to 26. But I guess the other side of the argument is, well, the sort of the guidelines are there for a reason. We're happy to leave money on the table to avoid as much as possible the risk that the support for it's not really there. Would that
Correct.
be correct in saying that, Tony?
Yeah, very much so. I think the trend line's like an insurance policy. So yeah, waiting for the sentiment to return is just, yeah, the cost of doing that, missing out on that first 20 or 30% of the rally, is the price of the premium. But the insurance is there that we're buying something that's definitely back into an uptrend and isn't going to, well, it may turn down, but isn't probably as likely to turn down as it was earlier on in the uptrend.
So yeah, I think the other point around this is more around the when you are in an uptrend, you see, like, for example, Macquarie last week was going on, I think 6%, 5% every day. And the feeling I get, is it too late, for example, to jump in? Do you miss that uptrend? Like, are you getting to a peak? I think that's when you see those uptrends going so quickly, you might buy a slightly higher point than you would have if you bought earlier. And whether, or is the trend or is the 3-point trend line guarantee, or not kind of guarantees, but kind of takes into account that this is what's indicating the potential growth on a longer term.
Imagine how the people buying Afterpay must feel.
Yeah.
They're probably pretty happy it's bounced back.
But that's what
exactly.
That's what I'm
that's
saying,
exactly it. Yeah.
they're bouncing back, but it's been going up and up and up and up. So they're buying after the last 1,000% of growth they've missed out on. The people buying in.
Yeah. Well, just getting back to Macquarie, I mean, I think that's probably a good example of where the 3-point trend line favours stocks that were in an uptrend before the downturn. So the banks that we looked at, the share price was going down from left to right on the graph. And so our 3-point trend line for those is going to be a lot higher above the current price than for a stock like Macquarie, where it's a much sharper sort of 3-point trend line that goes from, that high point there through the next month there, and we're meeting it around the share price now. So I think that's one of the benefits of using the 3-point trend line. It's filtering out those stocks that were in a downtrend anyway from those stocks which were in an uptrend. We get much earlier buy signals on the uptrend stocks than we do on the downtrend.
Yeah. Thanks for that.
That's all right. I know it's kind of counterintuitive. If you're a value investor and you see something that's compellingly priced, you should buy it. But it's just been my experience in the past that you just don't know. Or can you buy with confidence in a stock that's going down, even though it's got some good figures and it's turning up? It's early days yet, I think, in those cases.
Yeah, I think the takeaway from you for this one, sorry, I don't want to hug the conversation, but I think just the takeaway from me is that for the stocks is just that rather than focusing on everything that is on the market, you focus on the ones that have been on the uptrend over the last 5 years, rather than just actually picking those ones. So you that filters your stock even further to choose from, the options to choose from.
Yeah, I think that's generally correct. The turnarounds, the ones that were in the downturn and are turning around, it will take longer to meet that 3-point trend line for a buy signal. So yeah, we need to have a lot more evidence that they've turned around, I guess, before we buy them.
I think I'd add the other side of it too is it's not like we're struggling to find stocks that meet the checklist. If we were hard up, we might start to look at things that where we have to break the rules. Or if Tony just wakes up one day with some musings and goes, you know what, fuck it, I'm just going to buy NAB anyway. Who knows? He's growing a beard. Who knows what's next? But outside of that, there's plenty of stuff out there for us to buy that is scoring well. So from my perspective, I don't want to take unnecessary corners that are doing 150 when there's a fairly safe and narrow path there to drive down already.
Yeah, and look, we'll look back in a couple of years' time and say, geez, wish we had bought super cheap at or super retail group at, you know, whatever, at the bottom of the market when we could have, and we let it go. But, you know, there'll always be cases of stocks that we let go. But on average, we'll do better by following the process.
Tony, can I ask, hello everybody, can I ask, you had the super retail up, and also I want to ask for Accent Group. I just keep getting confused when you have that big drop and then the tick up, when we can go down the drop and measure it, or when we have to go back 5 years and measure the peaks. So Accent one was one that you sent me through some emails for, and you were still just measuring down the sharp drop rather than going from the peak on the left across. So I just need some clarification of when we would go from the two tops and when we can go just straight down the side.
Yeah, look, that sounded funny. That we always take the highest peak. The difficulty with Accent Group is there's two peaks with the same price. So,
right.
yeah, look, so I would probably take the rightmost peak in a situation. We could, if you want to be super conservative, you draw a line from July 16 across to December 19. They're both the same price, and you come out with $1.87 as the buy price. But given they're the same height, I'd probably use the rightmost peak and draw it from there. So it goes down from there to the next month, or the next peak, I guess, to the right, which is $1.65. And we get a line that goes down that way and is meeting around $1.30ish, maybe a little bit lower. Yeah, which is not too far off where the price is. Bear in mind, I don't know if you were part of the Zoom call, but I realised there was an article today that said that Brett Blundy, who was a director of Accent Group, has resigned, and the share price has dropped about 10% since that came out. So Accent Group will score lower anyway on our checklist because of that too.
Yeah. No, I was just using that as examples because I had a chart from you that was using Accent and it was coming straight down that line. So then I think Maddie said something on the group chat and I go, no, you go down, and I did the same thing. And then you came out later and go, no, you got to go across. I'm like, oh God, when is it across and when is it down? So I kind of just wanted to check that out. So interesting you said about those two peaks in that chart, because in super retail, you sent through your drawing of that, and the bottom for the sell line, you used it had 2 months where it had the same, 2 months in a row that had the same bottom sell price. So you just had a straight line across the bottom. So you kind of didn't have a sell line that went up at all. And I thought that was unusual. So can you tell me why you would do that?
I'm just looking at I can't recall what I sent through to you, sorry, but just looking at the graph here now. I'm assuming you can see it in the Zoom chat. But the bottommost point is at 60 cents in May of 2017, and the next bottommost point is now March of this year, and so the line would be from those 2 points. So the sell point would be just north of 80 cents, maybe 81 cents.
Hang on, is that super retail?
Yeah. Oh, sorry, no, this is Accent 1.
Yeah, no, super retail. Please.
Super retail, okay. Super retail.
Yeah, so the double bottom on that one. Whoops, gone again.
Oh, that one there.
Yeah, so you drew the line just straight across, which meant it was just going to, because I hadn't used the right-hand side part of that double bottom, and I've gone up to the next bottom one.
To that one?
Yeah, I went up, and when you posted your chart, you had straight across, and I thought that was unusual. So obviously I was being more conservative than you, but I just wondered if there was any history that meant that you knew to draw the line that way, or just because they were the two bottoms, full stop?
Yeah, just because they were the two bottoms. So yeah, look, I don't have a problem with what you did, which is to take that rightmost one and the next one.
Yeah.
It's just going to give you a bit of a slightly higher sell point than the one I drew, but So mine was 680 and yours is going to be around sort of 730. It's not a huge difference, but you could probably use either. The reality is that we've now got another low point in the recent past. So you'd really have to wait for something else. I mean, technically using the graph the way it is now, you've got a low point here and the next lowest point is on the way up. So the sell point using the lowest and the next lowest is going to be around $7.50.
Yeah.
So we're still really in sell territory for this one, I think.
Sorry, say that again, please.
Yeah, let me just see if I can get Cam, I don't know if this is going to work. I'm going to try and take a screen grab of this so I can draw on it. And let me know if it shares with you.
Yeah, you might need to just make sure you're sharing the right window, but in theory, you should be able to do that.
All right, hang on. Let me just see if I can do that then. Oh, I've lost it. Hang on, I'll do it again. Sorry about this. Failed to open page. So we were super cheap. I don't know if this is working because I lost the whole thing then. Yeah, so I'll try and do a screen grab of it again. And if I go and try and, can you see the graph I've just opened?
No.
No? Okay.
But just pop over to your portfolio section in Stock Dr. Tony and show us what you're running with there, mate.
It's not loaded. Okay, how do I get to show you this then?
Tony, you can go into advanced charting on this, right? So if you click on the advanced charting at the top there, that'll let you draw the lines then if you go.
Oh, can I? Okay.
Yeah,
thanks,
so
Steve.
just there, click on advanced charting and then you can change it to 5 years when that comes up as the range. And you're going to change it to a line or however you like to do it. I normally change it to a line instead of the little candlesticks. And then you should be able to use the drawing tools on the left. So on that far left side, there's a little drawing tools tab that you can click on and then that'll let you draw the lines normally.
Okay, just I've got the Zoom call overlaying this. There we go, that's got rid of it. Where's the drawing one, sorry?
So just where your cursor is there.
Oh, drawing
tools.
Okay. Yep.
And then normally, yeah, that'll now let you draw, you know, if you go to the bottom point there in March or wherever it is, I think it's either left or right click normally, and that'll allow you to put the first point on, and then you can kind of just, go to see on the left again where it says lines.
Yep.
And segment. I think you have to click on that from memory.
Okay.
And then go over to the point, and that'll normally let you start your line. Yeah.
So the interesting thing is this looks different in advanced charting than it does on the front page of Stock Doctor.
Well, the front page is normally only 2 years.
Tony.
I'm
going back.
Sorry?
You're back to 2009 on your graph there, Tony. You might want to set it to 5 years.
Yeah, the 5 year. Okay, yep, gotcha.
Yeah, and on the front page, the default is only ever 2 years, so you don't get 5 year options on that front page. You have to click into advanced charting to get the 5 year period normally.
Oh no, you can get 5 years. I was using 5 years on the front page.
Oh really? Oh, I haven't done that before. All right,
yeah.
I have to check that out.
You can also close that left-hand side so that we get the whole chart on our screen.
What was that, sorry?
Where you're clicking segment, once you've clicked it, you can go up the top of that column and you can close that again. Yeah.
Gotcha, okay. Yeah, so that looks fairly similar to the front page. Okay, so what I was saying is that the lowest point now is there and the next lowest point is there. So the 3-point sell line is currently heading up that way. It's not letting me draw it exactly, but that's the first point, that's the second point, and it's there. So it's still on a sell situation. And then the high points, let's see if it lets me draw it. That's the high point. that's the next one. So that's your buy. Your buys there. So yeah, kind of curious that we have both a buy line and a sell line, which are on the same sort of part of the graph. And this is, yeah, I'm not sure about this graph because it looks different to the one that we normally use on the front page.
Still only going back to beginning of 2017, I think there, Tony. It's only 4 years.
Okay, I've selected 5 years. I've got monthly.
That looks better. Now it goes back to 2015.
Yeah.
Okay, that means
So now
that
your high points in late 2015.
Let's see if I can get rid of that one there. I don't know how to delete that, sorry.
Yeah, there's a little delete up the top.
Sorry?
That's okay. There's a little bin.
That one? There we go, yeah. Undo. Okay, so that point there is 1136. It's now the high point. So I need to get the drawing tool open again. Segment. There. Every time I touch it, it changes. There.
I hate this tool. I never use it because it's clumsy. At least I.
Yeah, I normally take a screenshot and go into the screenshot.
Yeah, me too.
You click and hold the click button and then drag it. It changes the graph. So you want to basically just select your point, click on it once, go to the next point, click on.
Okay.
Automatically.
Our tool's going to be much better than this, Tony.
Yeah, good. Okay. I'm not sure. That graph looks different again though, doesn't it?
Now you're at 2019 at the end of the graph.
Yeah, okay.
Dragged it across inadvertently, I think.
Oh, yeah, okay. Yeah, that's a bit hard. I'm going to go back to the front page because that's, I think, just confusing things with that graph moving all the time.
You need a special 3-point trend wand to make it work.
Well, like I said, if I could share the screen print with you, I could show it to you. But let me just try and do that for a minute if I can.
I find it easier to do the thing on Reuters as well. I think the graph doesn't move that much, and the drawing tools there much easier. That's from my personal experience.
Right. You share. Oh yeah, I think I can do it. Here we go. Try that. Can you see that now?
Yeah, that worked.
Okay, so if I'm going to draw a line, oh, I don't know if I can do it here now, can I now? There's the tool, yep. There, line. So by line, that's the highest point. Next highest point. So it's going to be either there or there, because you can take the rightmost as well. But again, they're fairly similar. So it's going to be around just under 10 or $9.50. And then for the sell line, it's down here. The lowest point's now here. And the next lowest, oh goodness, not on there. Hang on. Let me undo that. I'll start again. That disappeared off the edge of the page. Yeah, so there's our sell. Taking the lowest point there, the next monthly lowest point to the right, and drawing a line. So it's current price is below the sell line and it's below the buy line.
Tony, can you? We've probably done this before, but I don't think we've done it for a while. Can you talk us through the theory of the buy line and the sell line? What's it actually showing us?
Yeah, look, it's showing us sentiment. So, it'd be great to be able to actually do research on this. My theory is that if you look at a share price graph, you've got a certain number of the people who are buying this share are long-term holders and a certain number of people are short-term holders. So the long-term holders are going to be represented somewhere in that graph and possibly towards the middle of it. And all the peaks that we're seeing are people who are coming in and going out. So to look at the tops of that graph, what we're saying is the long-term players are still in there, and there's more short-term players coming in and holding on, if you like. So as we reach new highs, we're getting more shareholders buying the stock, which is sentiment. And so what we're looking for is for that sentiment to be at least as strong as it has been in the past, which is the buy line. And the same thing in reverse is when we start to see a share that does this, we're seeing selling not just from those who are, have bought in and sold out, but also the long-term shareholders are selling out. And so it's a certain percentage of both. And so that's our sell line. So, and before this recent dip, the sell line was going to be around here, which is what we were talking about before. That was a sell line in there, either there or there. But I think, probably around there. So that's the point where you can categorically say that not only are the short-term holders selling out, but also the people who've been in it the whole way. Some of those are selling out now. So the sentiment's really collapsed in the stock.
Interesting that those two sell lines basically come into the same place.
Yeah, they do, don't they? Yeah. Yeah.
So I still don't really, like, if somebody put a gun to my head and said, explain this in a way that I can understand it, I don't think I could. I mean, I can use the words that you just used, but I'm not that confident that I can actually explain.
Well, let me explain a different way.
The psychology that it's trying to tell me here.
Let me explain it a slightly different way. Pretty much all share graphs move in a range. So even if you looked at the long-term ASX share graph for the last 150 years or 100 years, wherever it's been long for, it would be going up, but it would have a range of peaks and a range of troughs. And in rough terms, sentiment's strong when we're going up towards the peaks, and sentiment's weak when we're coming down towards the trough. So looking at this graph, weak sentiment, weak sentiment, weak sentiment, and then a complete drop in sentiment. So, sentiment's fallen through the bottom. And likewise up here, strong sentiment, strong sentiment, strong sentiment, and broke out there. So that was a breakout on the upside. So that's really what we're looking for, is when does the stock stop trading in its range, which is kind of like its normal trading pattern, and break out either on the ups or the downs.
So, Tony, just taking that example then, what confuses me a little bit then when we look at this is I get it, right? Like there's a range, but what we're saying at the moment using the current buy price, using that methodology is it's got to be above 950, which in the last 5 years, it's only briefly been above 950 once. So that's where I struggle a bit. I look at it and go, well, why is it got to be above that price to buy it when it's only been above that range or that price, very briefly once in the last 5 years?
Well, I think it's been above it 3 times, so that's 950 there. So once there, twice there, or more than that.
Oh, I see. Sorry. So you're right. So even though the range was high, the actual price was high. Yeah. Okay. Got it.
Yeah. So what we're saying, Steve, is look at the range. It's in a downtrend.
Yeah. Yeah. Okay.
So we could buy it. Look, we could buy it at 670, and we might get it back up to $9, but it might go down again. If it stays in this range, and that's an if, it's going to keep going up and down on that range. So the lows will get lower and the highs will get lower. So you can still certainly make some money by buying at the bottom of the trough and selling on the way up to the top of the trough. Absolutely. But the 3-point trend line in this case, I think, is insurance to say, are we buying a stock that's going up long term, or are we buying one that's just trading in the range but still going down?
But if you take your other buy price methodology and you take the rightmost peak and then the next rightmost peak kind of thing, and that brings us back down to, $7 or something, or $6.50 again then, doesn't it? Doesn't that then give you the chance to get a lot more upside? Like if you were to take that peak from January and then bring it down to the one that was recent.
Yeah, that's not.
Or is that not how you do it?
That's not how I do it. No, I take the high.
Yeah, okay.
I completely invert the process for a sell line. So I take the highest point on the graph and the next highest point and draw the line that way.
So if those peaks weren't there back, 4 or 5 years ago, then you'd be taking this peak in January, right? And then you'd be going January down, that's going to bring us down to 650, and we're going to get in above 650. And then if it reverts back to the top of the range, you're going to make a ton of money, right? So if the peaks weren't so high 4 or 5 years ago, this would be a different buy price.
Yeah, but the peaks being high 4 or 5 years ago tell us it's in a downtrend.
It's in a downtrend, yeah.
But you're right. So like that peak there is I don't have the x-axis anymore, but that might be 18 months away. In 18 months' time, the graph is going to roll to the left, and those peaks will disappear.
Yeah.
And so, well, probably not so much in this case. It has to roll across to about there. Yeah. But then you can draw the line as you're describing it, and the buy price comes right down.
Yeah. Okay. Or if it had drifted sideways for a long time, the buy price is going to be lower as well, right? When you have a big drop off like this. So
yeah.
Okay.
But like to the point we made before, this is a completely different scenario to a Macquarie Bank where it's in a range going up like that, and so we can draw our line from the high point down and buy it much sooner because it's rebounding in an uptrend, whereas this is rebounding in a downtrend.
Yeah. Which I think this goes back to the stock doctor measure of the growth over 5 years, if it's positive. So I think that kind of picks that overall 5-year trend for that, right? I think the one thing I want to check, why 5 years and why monthly? Why couldn't it be 3 years and weekly?
Yeah, it could be. I mean, so the reason why I use 5 years and monthly is to take out all of the short-term chops and changes. So, you could use, well, Stock Doctor uses 2 years weekly, right? But I found Stock Doctor buys and sells a lot more than what we would by using the 5-year monthly. So I'm trying to get the long-term trend patterns in place using 5-year monthly. But like, I suspect this is actually a fractal way of investing. You could do it. You could probably even day trade if you took an hourly price graph last day, right, and applied the same sort of methods to it. Because basically, it's momentum trading. We're looking to follow things that are going up and get out of things that are going down. But by using the 5-year monthly, I find that it gives it it takes a lot more movement in the price to create a buy or a sell. So it tends to mean less trading in the portfolio. Now, I know we're doing a lot of trading now, but it's a very volatile market. But ordinarily, we wouldn't be trading as much with the 5-year monthly as we would be with a 2-year weekly.
So if I can try and paraphrase all of that, Tony, sentiment is really another word for confidence, the confidence that the market has in the stock. And what we're trying to do is buy into stocks where the confidence is getting stronger year after year because it's a quality company that's getting consistently growing equity, consistently growing cash flow. It's getting better and better every year. You don't want to trade very often. You're not a very active trader. You're a buy and hold trader, and you want to buy and hold companies that are getting better every year. So the confidence is getting better on average every year. And what these lines are telling us is there consistently growing confidence in this stock in the market, or declining confidence in this stock? And if it's declining, we don't want to be part of it. If it's increasing confidence, we want to be part of it.
Yeah, and look, it's completely an overlay because as we've seen, like with the Coronados and Apollos and maybe Myer in this world, we can find stocks which are compelling buys on the value basis, but having the sentiment check on things is a real handbrake, saying, well, hang on, have we got this right? Because other people aren't seeing what we're seeing, or they're seeing it, but they know that it's a bit of a trap. That because they think the future of the company isn't as bright as what we might think it would use. So it's trying to combine the contrarian nature of value investing with the wisdom of the crowds, really. Which is,
Tony,
doesn't follow Buffett, but it kind of works.
And Tony, do you know the monthly price? Is that the average price for the month? Is that how they chart it, or is it the first of the month or the end of the month price? Or like, what is the actual monthly price?
End of the month price.
So it's just whatever it was on the last day of the month, that's what they're plugging in for that month. Okay.
Yeah, closing price. Yep. Yeah.
So
Well, we had a bit of a problem, and halfway through April, we bought some stocks and then sold them again when the closing price for April came out.
Mm-hmm.
So Paul, the lawyer in Sydney, for some reason, is sending me messages in the chat window rather than talking in the microphone. But he's saying, Tony, can we summarize the SUL chart by saying that as the stock is in a 5-year downtrend, you take a more conservative buy signal, being one that is more firmly entrenched, and when the stock is in a 5-year uptrend, you take a more aggressive approach as to the buy signal?
Correct. I use the same methodology in both cases. It just happens to work that way. But yeah, that's exactly right. If it's in an uptrend and it's turned down, then I'm more happy to buy it quicker than if it's in a what I call a long-term down or a cyclical downtrend, or not a cyclical downtrend, a long-term downtrend. I need to have some much more confidence that it's not just going to go up and down again.
Well, thanks, Tony. I feel good about that. I'm glad we had this chat. Thank you, everybody.
Can I ask
Tony,
about
could I just jump in there for a sec?
Sure.
me?
I think you were first, Angela. Jump in.
Okay, thanks. Share analysis, there's been a lot of chatter about whether we should use that or not. And Tony, I know you said, well, you know, it's up to us to have a look and see whether it works or not. But you're the one with all the data. I'm just wondering whether you've actually gone backwards retrospectively and had looked to see if your decisions would have been different if you hadn't have used it. Have you tried that at all or not?
I haven't, but before I put it into the checklist, I was finding that it was useful particularly because it was a different way of quantifying the quality side of things with their A1 to B2 ratings, and so that was useful as a different differentiator to Stock Doctor, but so a different way of doing the same thing. But also too, they used to use Roger Montgomery's IV calculation method, which was based on his book Valuable. But just in this last little while, I think they're doing something a little different now, because it looks like it's tied more to the consensus forecast. So I still use share analysis, but I think if I find that it's just using the consensus forecast, I might give it away. But
Yeah.
I'm going to run it sort of for a bit longer until I can form that opinion.
Yeah, I like the idea, but wondered if there is if anyone's come across anything else that they can use instead.
I've been actually checking. I've been testing out the Simply Wall Street thing. Actually, I like the way it's structured. I don't know if anyone else has experience with it. I'm still trying to map it to the QAV score list and what it can be used for. So that's still an exercise, undergoing exercise. But I like that how it's structured, and it goes into different areas and it scores different points and for each area. So potentially they might have an area that is similar to what the share analysis tool has, that can comparable to the A1, A2, B1, B2 kind of those scoring systems. But yeah, it's still a work in progress for me. And on the same point, I'm not sure for the valuation. I'm not sure how Morningstar and Goldman Sachs kind of those reports, whether it's worth actually using them as fair value for instead of share analysis, the stuff that you get from ComSec. Or I'm not sure if anyone has thoughts on that.
Yeah, I'm sorry, I don't have any sort of experience with those. I had a quick look at Simply Wall Street, and yeah, certainly it looked like it might be useful, but I just haven't done the research to say whether it is or not. I suspect it probably is, but yeah, I don't know.
Thanks.
Certainly, I mean, the thing that appealed to me about Stock Doctor and share analysis were the methodology. So Stock Doctor used the work of Merv Lincoln, who went back and did a regression model on all companies that have gone bankrupt on the ASX historically, and then used that as the basis for his quality rating. So basically, if it went bankrupt, here are all the metrics that had to fail, and then he flipped it and said, if companies had good scores on those metrics and they were unlikely to fail, And so that's how Stock Doctor's quality ratings work. And then share analysis used Roger Montgomery's ratings. So I think from memory, the letter score is the strength of the balance sheet and the number score is the strength of the P&L. Might have that the wrong way around, but that's how he did it. And so that was appealing as well, because I could see the, inside the black box of both of those, and they were good. But yeah, they're certainly not the only ways. There'll be other ones out there.
If we've got that chap's name that that does the share analysis, I know I've got it somewhere, then what would we ask him to clarify if he's still using? What was the method that Roger Montgomery uses what's the wording we would use to ask him?
Yeah, so it was based on Roger's book called Value Able.
Yeah.
And and so Roger co-authored share analysis back when it was called Scaffold, and he was using it internally to run his own investing business. So it was automating the work that he was doing by hand before that. But I know that when we spoke to the guy who took over share analysis, he did seem to say that they were using the consensus forecast as a starting point for their IV calculation. So that says to me that they've moved away from Value Able. I didn't ask him directly, but it seems like they may have.
Right.
I could reach out to him. Cameron Britton, his name was.
Okay,
good first name, so he's probably trustworthy. I can reach out to him and see if I can squeeze out of them what they're using now.
Yeah, sure.
Or even a better deal.
Sure.
Thanks.
Okay, anyone want to, we've got 10 minutes left. Anyone want to ask another question?
I think Dave's trying to, but he's muted.
How's that? Can you hear me now?
Yeah.
Hey, Dave.
G'day, how you going? Thanks for your patience teaching us all these 3-point trend lines. I've got the Value Able book here. I read that years ago, but I think they teach you how to calculate an intrinsic value in there, if I remember correctly.
Yeah.
So potentially we could all, like, using Stock Doctor data, calculate our own intrinsic value using Roger's methods, maybe, as an idea.
Yeah. The only problem with that, Dave, is if you look at it, the book, it gives you a table to read off. So you could do it mechanically. It doesn't give you the calculation behind that table, unfortunately.
Okay, so it'd be time consuming, but
yeah,
maybe an option.
So yeah, you could certainly have the figures in your spreadsheet and then Value Able open to that table and run your finger down the table until it finds the right number.
Yeah.
Yeah.
I just had a question on, just to clear a few things up for myself on these 3-point trend lines. Just Credit Corp for an example.
I've got so many things open now. Let me just try and find it.
I can see everyone now. Hi.
Credit Corp. Okay. Yep. Can you now? I need to share this page with you. I think. Hang on.
That's the guy. Looks pretty good there, Cameron.
It is, mate. Come over and you can have a puff.
Can you guys see that? See that's my screen now?
Yep.
Okay. Yep. So shoot.
So I was just looking at, the looks like it's broken through the sell signal. So I do the low points in, I think, sort of October 15.
Yep.
Through sort of Feb 16, April 16, up through that way.
Yep. Correct.
And so then it's broken through its sell signal there. And then my interpretation is this would be a bit of a Santos. So it would go up to the top, which was in January. And then the second one down Feb, and we'll draw a line down through there for a buy signal.
Yeah. Looks like it might be around about $26, $27.
Cool. And my question there was, so we've got the buy following the sell, do we then redraw the sell line off the current bottom in March?
Yeah.
So it would go there.
Yeah, so it's going to be from 30th of October 2015 through March 2020.
Okay, cool. So we're in a bit of no man's land.
It's getting very close to a sell again.
Cool.
Well, it's still in its sell. It hasn't reached its buy. Yeah, it's a really hard one. Credit Corp's been one of my favourite companies for a long time, so it really hurt me to sell it. But it's actually not a bad example, because having that high buy price, or the sort of steepish line coming down, but still crossing around that sort of $27 mark or $27.50, which is a long way above the share price. Again, I was thinking, well, it's a company I like and the numbers are compelling. Why aren't we buying? But as you can see, it went down a long way, staged the rally, and now it's going down again. And that's always the risk with these companies. If they can't establish an uptrend, then having a high buy price is actually an asset, because this might trade sideways or trade down for a while.
No, great, thank you for that.
And I think just on Credit Corp, I think the reason why it's doing what it's doing, this is just a hunch. Back in the GFC, it did the same thing. So when we go into a recession, its business kind of clams up, both in terms of being able to buy distressed credit card in particular, but all sorts of distressed debt, list personal loans and credit cards in the main from banks. The banks sort of stopped selling it for a while. I don't know why, but potentially because they're waiting to see, how much they can collect themselves and whether it's a bit unusual at this time. So the banks kind of wait for things to settle down before they start selling this distressed debt. They call them ledgers, distressed debt ledgers, into the market. And so Credit Corp, can't buy any, which is where it gets its business from, and it's also working harder to collect the debts from people who can't afford to pay in the recession as well. So it kind of has a double whammy there, and I think we're seeing a replay of what happened after the GFC. From memory, the share price went all the way back to $1 or something around that during the GFC for that reason, and it's kind of doing that now. So as much as I really like Credit Corp, I'm happy to wait a bit longer and let it shake out this whole recession.
Right.
And meet our 3-point buy line again.
So I guess my question was you've answered it beautifully, but once the trend line is broken, then we re-establish another one off the next high or the next low, whichever way it's going. Is that sort of, does the line lose its validity once it's broken through?
Well, yeah, as we scroll, as this chart keeps scrolling each month, we'll probably find that there are new buy and sell lines. Well, probably not so much a buy line, but the sell line might get tested again. So if 1450 becomes 1250, then we'll have a new sell line. It'll be lower. And likewise too, as we scroll to the left, this buy line, which is coming down here, will, start to cross more like at $26 and $25 as we get further along in time. And so it becomes the case that it gets easier to buy Credit Corp over time, which is what it should happen. Really, we want to see both Credit Corp becoming less volatile and start to increase and sustain that increase. And over time, our buy price comes down and the two kind of meet. But it might be 6 months away, might be 12 months away, I'm not sure.
No, that's fantastic. Thank you for that.
Yeah, okay.
Thanks.
If I can jump in, Tony, Paul in the chat line, apart from complimenting me on how good I look, says two things. He says, Roger Montgomery says in his book, if you email him, he'll send you the Excel spreadsheet with the calculations. So
oh, good. Okay.
I'll have a crack at that. And
yeah, excellent.
He also has a question. He says the SUL chart showed almost a 10% short. Were we going to add this as a checklist item? I know you talked about it a while back.
I did. Yeah, I haven't yet, but look, it's probably not a bad time to revisit it. It wasn't the number of shorts that I was looking at, but it was the trend line. So SUL's been going up, and that's probably a bad sign, I think.
Can you talk us through that? What does that mean?
Yeah, so at the bottom of the stock doctor graph, are you still seeing my screen, Cam?
Yes, mate.
Yeah, so this is the screen for SUL. At the bottom of it, you have the option of making it, I think, transactions by day or percentage shorted. So you can see that SUL from 2016 in August up until now, there's more people shorting the stock, and that's coincided with the decline from those two peaks on the left, if you sort of stopped the graph here and went backwards, it's not a bad graph. But ever since then, it's been going down, and the shorts have been winning, if you like. They've been buying and selling more and more of the stock, shorting more and more of the stock. So yeah, good question, Paul. I haven't put it in the checklist, but I should go back and revisit that and just do some analysis now that we're in a bit of a recession and see if it works.
So what I meant by my question, though, mate, was if people are shorting it, that means that they have low confidence in it. They believe the price is going to go down.
Yeah, they're 100% betting that the share price is going to go down, because what they're doing is they're borrowing stock or renting stock off a fund, like a industry super fund, for example, and then selling it straight away in the hope that they can buy it back cheaper and then give it back to the super fund. And that's their profit. So, for example, if they had borrowed it from a super fund at $10.08 back here in December, they could decide now that they'd had enough and they're going to sell it for $6.70, and they made $4 on their 10, so they made 40% in a few months.
And we're assuming that these guys have done some deep analysis on the company and the sector, and they if they're taking that kind of gamble, they think they know what they're doing.
Correct. Yeah. Yep. They're often like in the extremes. The shorters are almost like forensic accountants, and they'll go through and pull apart a company's reports, it's their P&Ls and balance sheets, and try and find holes in them. And in some ways, they're doing the job which we don't do, which is, you know, I steered away from using profit as an input into the checklist because I knew that, you know, profit could be manipulated. These guys are trying to prove the manipulations, if you like, and they're calling out and saying, well, hang on, I'm not saying this is the case with super cheap, but they're calling out and saying, well, you're saying profit is X, but really you've pushed forward sales, or you've priced your inventory and all this kind of stuff to suit your profit, to inflate your profit. So they're kind of calling it out, and they're therefore betting the share price will go down. And sometimes they make that information available to the public to try and force the share price down, which is one of the reasons why CEOs always calling for the end to short selling, because they get found out. Yeah, but I guess there are also probably momentum short sellers. So if you look at the super cheap auto graph and you have a macro theory that retail is struggling because online's, you know, moving in and taking over some of that territory, you can take a macro position and start to short a lot of retail stocks, which would have been a good trade as well. So they're not just forensic accountants, they're also people who are taking a macro theme sometimes as well.
Can you remember a situation where a stock had positive sentiment but growing shorting?
Not offhand, no.
So if it's got positive sentiment, it probably means that there's not a lot of shorting going on, and it kind of negates the need for tracking the shorting, maybe?
Let me just have a look. JB Hi-Fi springs to mind. That's one of the ones which were a part of this short retail macro theory. And you can probably see it on the screen now that the shorters kind of had to get out. So that's one of the other nice things about taking a position against shorters, is that they're kind of forced to throw the towel in if the share price keeps going up. And that can also, it's called a short squeeze, and that can sometimes also push the share price up because it gets all the shorters off the register, and then people who are on the register are long-term holders. So this is one which is in a general uptrend. JB Hi-Fi had quite a high degree of shorting. At its peak, it was 21%. It's still around 11% now. So even with 11% of the register shorted, the share price is in positive sentiment territory. So that's probably an example of what you're saying. That's one stock I can think of which is going up but is being shorted heavily too. And that's why I said before, I think I'll probably look at the trend, because the trend in shorting is halved in JB Hi-Fi during that last upswing in its share price. But yeah, it's something I need to do more work on and try and land on the position about and one of the things about putting it in the checklist is you've got to have a good rule for it. So I don't have a good rule for it now. I think it'll be around reduce the short positions are reducing, but I need to go back and check all that.
Yeah, I mean, I held a stock last year, Tony, Rural Funds, which is a property REIT that focuses on agriculture, and it had a offshore short attack in the middle of last year, and the price plunged 40% in one day, and it was subsequently found that all the allegations the shorters pumped out there were all bogus, and the company has successfully sued them in the New South Wales Supreme Court. But this seems to be a bit of a trend, right? That you get these offshore guys that think they're protected from Australian law and they can just make the story up to suit their case. So Rural Funds was tracking along quite nicely. And then the shorting did increase for like a few weeks before the research paper got circulated. And then obviously, I'm guessing they would have sold out, when it dropped 40%. And it's bounced back a little bit, but not a lot, considering the management's come out and also had two separate accounting firms come in and audit the books and, prove the case and all that kind of stuff. It still hasn't bounced back. So, some of this mud sticks, unfortunately, when there's a short attack, even on a legitimate business.
Right.
So I don't know about shorting, man. I mean, personally, where else do you short things? Why can't you short a car or a house? I mean, it just seems to me that, it's not, I don't know that it really is necessary. I mean, isn't that the job of analysts and investors to kind of, pick through annual reports and management and, figure out whether they're telling the truth or not? And stock doctors, health model, it just seems to me like sometimes legitimate businesses or, legitimate investors get whacked through guys making stuff up.
Yeah, look, I take your point, although I think it's maybe the exception. But I'm open-minded about short selling because, if you look at, say you look at stockbroker reports or recommendations on stocks, you'll never see too many sell recommendations. I mean, the system's basically corrupted because the investment banks and the stockbrokers want work from those companies to raise money in floats or to do acquisitions or divestments or whatever for them. So there's always, far more, like probably 10 to 1 buy recommendations than sell recommendations.
Yeah. Okay.
And generally, if you look at the broker recommendations and the fund manager recommendations, they'll use hold when they really mean sell. So you get buy, hold, and sell. So hold really means sell, and only in the like after everyone else has sold the stock will you see a stockbroker come out and put a sell recommendation on it. So I take your point that there are some cases where the sell side has been corrupted and these guys have published false claims and it's hurt the stock price. But by the same token, they're generally the only ones in the market who are trying to call out bad accounting and bad companies, and they've also had a good track record of picking them. So if you look at things like corporate travel, ABC Learning when it was around before it went broke, Blue Sky Investments in the last couple of years, they were all subject to very detailed reports on how the tricks they got up to with their accounting, and without those reports, they were always just being boosted by the analysts in the market who were either wanting to get on the gravy train in terms of more work, because particularly in those kind of companies where they're for ABC Learning, which was a kindergarten roll-up, and for Blue Sky, which was an alternative investment manager, they're always going to the market raising more funds. They're always going to the investment banks asking for help to acquire another network or another asset. So, none of those companies, which also have broker recommendations, are ever going to put a sell on them, even though they deserve it.
Yeah, good point. Eddie Groves from ABC's in the US shale oil business at the moment, mate, and it looks like he's losing more money again. So don't follow him wherever he goes.
Not for long.
No. Just quickly, one interesting conversation I had earlier this week that would be open to any comments you had. But my private banker at Westpac called me wanting to sell me an unlisted property fund. with a pretty shitty return, which I politely declined. But I took the opportunity just to kind of ask him what has been going on with their accounts and their customers. And he's in the Melbourne Westpac office, and he said it's crazy. Like, they're just getting inundated with requests from businesses for assistance and help and relief. Tons of people with serious incomes that have evaporated and are looking for assistance. And he's even getting people with money in their offset accounts that can cover the loans that lots of them asking to defer their payments as well, which is really just, so I can see, it's going to capitalise their interest, right? They're going to end up paying interest on interest, which seems a bit unnecessary. But I guess if you're the bank, you're happy with that, probably, right? Because you're going to collect even more interest down the track. But anyway, he is a good guy, and I've had quite a long relationship with him, and I believe what he was saying, that it's been been absolutely crazy, and that they're getting flooded with not listed companies, right, but private business requests for serious assistance and in serious distress. So I guess we're not hearing about that yet in the listed world, obviously, but it might be why the banks have all come out with such big provisions in their reports in the last couple of weeks, that they're expecting maybe a pretty significant uptick in bad debts, perhaps.
Oh, definitely. I'm hearing the same things, and that's why I suspect, I can't forecast, but I suspect that we're going to see another leg down at some stage in the share market, because all that stuff won't come to light quickly. It'll come to light over time. Yeah,
I sat in on a meeting with Michael Knox, who's the chief economist at Morgans this morning, and he's an economist, so he does make predictions, and he was saying that he thinks that based on where the analysts have got the earnings for the S&P 500, like, it's seriously overvalued right now, and he thinks there'll be another big leg down in Q3 once all the earnings numbers start to filter out for the majority of those companies. So again, it's a prediction, it's a forecast, not sure you can do anything about it, but for what it was worth, that he was kind of also thinking there's a significant leg down potentially in Q3.
I think on the S&P, and this has happened in the past as well, and again, I don't know what will happen, but it's the PE, forward PE is higher than the average. So that's the basis, I think, for saying it's overvalued. But that doesn't mean it might turn down. It might just tread water for a couple of halves or a couple of years, go sideways until the average comes back up to meet it.
Yeah, well, I think what he was saying, and also the economists at Beta Shares has said something similar. The analyst projections right now for the S&P 500 are about a 12% reduction in earnings for the quarter. And to me, that seems incredibly low, knowing what's going on in the US. So I've chatted to some of my guys in the office, the footwear business over there, and their revenues are down 80% on where they were a year ago. And this is a listed footwear business, so and the footwear industry in the US is a $70 billion industry. So it's it's a pretty decent little slice of what's going on in at least the consumer part of the economy there. So, and we're one of the top brands. Like our business was in the top 20. So customers want our product. It's not like it's a crappy old brand that no one wanted to buy. And they're also projecting at the moment that maybe a third of the customers that we served aren't going to make it. There's about 5,000 customers on the books, and our guys think probably 1,000 to 1,500 of them that are smaller ma and pa type operations or department stores that are at worst going to close up entirely, or at best close some doors. They think they're going to lose somewhere between 1,000 and 1,500 doors. So that's like a third of the account base, and that's not public anywhere yet. You know what I mean? That's just internal talk. But if that's any reflection of how a lot of the S&P 500 companies might look in 3 or 4 months' time at the next reporting, I can't see 12% being the number. And at 12%, that's still got the index at like a 20 times PE. So even at a 12% reduction, it's still really expensive, right? If it's more than that, it's going to be an even higher, ratio right now that it's selling at. So I don't know. Who knows? But it seems to me there's more risk on the downside than the upside, hearing all that stuff.
Yeah, look, I kind of agree, but I think what's also happening is that people are saying, let's just write off 2020 out of our DCF and look at what we think will happen next year, the year after, the year after, the year after. taking a long-term view and assuming that it all gets back to normal again next year. But, that may not happen.
But see, that's what I've been thinking, the same thing. But if those businesses go broke, it's not going to get back to normal. You'd have to think there's going to be a ton more people unemployed or not able to get, work as quickly as you'd hope. But I'm talking in the US here, right? Like, I think Australia's doing better probably, but about a third of the Bionic team's been laid off.
Right. So
I'm not sure those people are going to have, all of their jobs back by, January next year. So if the unemployment's there, I just don't see the earnings bouncing back that quickly in 21. It's might take longer. Who knows?
Yeah, no, I agree.
Tony, there's a couple of questions in the chat window. How are you going for time?
Yeah, I'm good. I can't see the chat window though, sorry.
That's all right. I'll read them out to you. Matt asks, has Tony used a momentum tool to help enter and stay in or get out?
Well, that's the 3-point trend line, really, isn't it?
No other momentum tools you use?
No. When we talk sentiment, we're talking momentum as well. They're almost interchangeable words.
Right. And Paul had another question, but he hasn't typed it into the window yet.
I can sing it out if you can hear me.
Hey, Paul.
Yeah.
G'day, Cameron. G'day, Tony. Hi, Jenny. If this takes too long, let me know. A company called Link Administration.
Mm-hmm.
It's scored well previously when I've done the checklist, although its momentum is very poor. Sorry, its trend is very poor. But I wondered whether you ever took account of assets that aren't yet being accounted for in the business. Link Administration does superannuation, and they're, I think, largely a British business. As in based in the British superannuation industry. But they also own a 50% share, I think it's in a company called PEXA. PEXA's a monopoly that does all of the property title transactions in the eastern states in Australia. It's got a monopoly over it. Commonwealth Bank owns the other, and I think Macquarie Bank own the other 2 shares. And they've released a press release this week saying that Macquarie Bank are going to sell PEXA, are going to list it on the stock exchange. Mm-hmm. And it's got a $2.7 billion price tag on it, I think it is. Mm-hmm. $2.1 billion price tag. And at the moment, it just doesn't seem to me that the Link Administration price is taking account of 2 things. First, a massive asset that's potentially sitting on their books. And 2, PEXA has only this year become cash flow positive because it's an IT business. It's only now is its revenue actually hitting the bottom line in Link. Are you ever, looking at that chart that's in front of me now, it's a pretty unattractive one. It's a pretty strong trend down.
Yeah.
Is there anything tempting in that story to you? Or is that all in the forecasting bucket, which you're not interested about?
Well, first of all, the shareholding in PEXA should be on the books already.
Yep.
They can't have an asset that's not reported. So even if it's not listed, they'll still have to write a valuation on their book. So that's in there. It may not be fairly capturing the upside if they list it. Like if they list it and their shareholding doubles in value during the listing process, that's not going to be in their numbers. So you're right from that point of view. But no, the PEXA shareholding will be on the books already. Link has gone down because, like you said, it's an Australian company, but it does have lots of work in the UK, and it was marked down because of Brexit. So, people were doing the numbers on what it would look like after the UK pulled out of the European Union, and that's the main drag on sentiment for it at the moment. So yeah, it doesn't. To answer your question, no, I don't necessarily try and find a situation where I think there's an asset which is undervalued. I still use the same checklist and 3-point trend line methodology to do it.
Right.
But again, the caveat, I guess, with all this is that there are some people, like Steve is with the shoe business, who have very in-depth knowledge of these businesses, and if they're convinced, and you hold that kind of in-depth knowledge, then sure, you could go against the crowd and buy into the business. But I don't tend to get to that level of knowledge on any one particular company. I use a checklist and the 3-point trend lines.
Great. And very last quick one. Thank you for that. Have you ever run the numbers over image resources, IMA?
No, it doesn't ring a bell, sorry.
Scores well on the QAV. Sentiment is, I think, broadly upwards on this one. It's a pretty small stock, so it might be too small for you.
No, so yeah, not too bad. 120. Yeah, too small for me, but it's not an overly small stock. $123,000 a month traded.
Scores well on QAV. I get about 0.25. Maybe that's a stock we can put in the list to look at in a couple of weeks if you've got a slot on the show, maybe.
Yeah, sure. We can have a look at that one. What's it called? IMA.
Yeah. IMA.
It hasn't come up in any of my filters, so I'll have to go through and have a look at that.
All right, no problem. Thanks very much for your time.
It's okay.
All right, folks. Well, I think that's a night. Thank you to everyone for turning up. Thank you, Tony, for your time as always.
No problems. Does anyone else want to ask a question, Andrew or Matt? We haven't heard from you for a while. I can't see the full Zoom list here. Is there anyone who hasn't asked the question?
Tony, just thanks very much for your time and Cameron for putting it all together. I guess I'm still trying to get familiar with it and get the confidence to start putting some real money on the table. And what I've been trying to do is look through the stocks for that momentum, for that movement in the right direction. And I found just using 2 standard deviations in a channel the last 5 years has probably helped put me in the direction where I can see a stock that's suddenly out of favour since end of February, and it's well below its normal trading channel. And I guess I'm tempted a little bit on some of those things as well. Obviously, we're trying to find a point where we get in and where we get out, or where that becomes a point where we can move into the next trade. I've been listening to some of the investor podcasts which you've got down in your resources, the Stig Broderson and the Preston Pish guys, and they use a momentum tool to help them time when to get in and when to get out. It sort of takes away a lot of this guesswork on the graph. And that's why I chatted through to you, Cameron, just to see whether there was anything there that we could use perhaps to help just reduce the amount of subjectivity in that entrance, and also where to set the stops, because sometimes they use a volatility quotient, so they work out how much does that stock normally move up and down, and that gives them a fair bit of guidance as to where they might put the stop. Whether that's another point of conversation at some stage, but just your thoughts. Yeah, thanks, Tony.
Yeah, so I'm not familiar with those kinds of things. Certainly the 3-point trend line is its own momentum indicator. That's one of the reasons why I use it. It does have its history or its equivalence in moving averages. So you can, I think sometimes providers like Yahoo will have on their charts a moving average line. So it'll be things like the long-term 180-day average, and then the short-term maybe 60-day average. And when they cross each other, it's a buy or sell signal. So when short-term goes above long-term, it's a buy, and when short-term goes below long-term, it's a sell. And that does approximate the 3-point trend line. So yeah, there are other ways of doing it. It's funny that you say to take the guesswork out of it. I don't find it comes as second nature after a while. I don't find it to be guesswork. I can almost see without drawing a line what the answer is going to be. So I don't find it too much guesswork, but I can see why, particularly at the moment, it can be confusing. And it would be great to have a mathematical formula that can do it, so we don't have to even look at things. But I just haven't been able to come up with that formula. But hopefully we will one day.
Yeah, I think
sorry, Matt. Just send through some links to those other momentum indicators, and we'll have a look at them.
Yeah, no worries at all. We'll do.
Just to add to what Matt was saying, I think I was trying to do the same. I think now the 3-point trend line makes sense, and it's kind of like easy to identify. I think where the other indicators come in handy is if you can potentially create some alerts within, whether it's NAB or ComSank trade or whatever, like you could actually, rather than drawing the graph every day and check, or on a regular basis, you can create alerts that you can act on them straight away.
Yeah, so I did that in Stock Doctor, maybe. I don't know if you're a subscriber, but if I get something which scores well on the QAV checklist, and it looks like it might be getting close to its buy line, or it's on the way up, I'll work out what the buy price is this month and put a price alert into Stock Doctor, and if it crosses that price, I'll get an email.
But wouldn't the buy price or the sell price changes over time? That's the thing with the trend, right? As the graph moves, the price is fluctuating, is moving, like changing.
Yeah, that's correct. So I need to do it on a monthly basis.
Right. Okay.
Doesn't change month to month, but
yeah.
You have to relook at it each month. Yeah.
Yeah.
I think Justin has a question. Justin, are you there?
Yeah, hi Tony, hi everyone. I'm just a complete beginner, so I'm not sure if my questions are silly or not. But yeah, I'm just about to starting investing, and I'm not sure whether what is the best stockbroker to choose from, and you know, whether I should purchase a Stock Doctor subscription. Is that essential to get started? And yeah, and how much sort of money that you reckon that it's a good sort of, you know, amount to start?
So I've been using Stock Doctor right from the very start. So and it's what, $1,800 a year. So it's a reasonable investment, I understand, but it just, in terms of shortcutting all the time it takes to go through and analyse companies by hand from Reuters or Yahoo Finance, I find it invaluable. So you know, I'd encourage you using some kind of tool, whether it's Stock Doctor or some of the other ones that we've spoken about, Share Analysis, which is a bit cheaper, or Simply Wall Street, which is cheaper again, which I don't know much about. But I think if you start trying to do it by hand with the free stuff, you'll start to quickly realise you need to buy a tool somewhere. And I found Stock Doctor to be the best of the tools that I've used. In terms of getting a broker, it depends, I think, on how much you have to invest and what your needs are. So there are very cheap brokers out there, and I think, Steve, you have one that you use, which is about $10 a trade. That's different to the sort of broker that I use, who executes my trades for me, but I pay a lot more than that. And that's if you're investing a smallish amount of money, doing it yourself cheaply is a great way to start. When the money starts to get a bit bigger, it's almost like a whole branch of investing, going in and doing your own trades. There's all sorts of tricks and traps in buying on the market, looking at the spreads, looking at the depth and the volume and the amount that's for sale, or that is being bidded, so that people want to buy. And that becomes not a full-time job, but pretty close to it if you want to try and get the best price. So yeah, so start off with an online broker that's quite cheap, and then you might find that you need help with the actual executions of your investments, and then go out and look at a more of a full-service broker who'll do the trading for you.
Just on costs for Stock Doctor, Tony, I mean, one thing that I found was I joined the Australian Shareholders Association, which I think, you know, Cam joined me at one of their local meetings at one point. But the fee to join that group is like $130 a year, and they have a national conference that Stock Doctor sponsor, and at the conference every year they do a deal for ASA members. So I got my Stock Doctor subscription for the equivalent of $1,400 a year. It was like 25% off or something if you do it at their annual conference deal kind of thing. So yeah, if anyone isn't on Stock Doctor, or if your subscription's coming up or something, you might be able to save some cash if you were to join the ASA, and then because of that you get their annual deal kind of thing for what it's worth.
Yeah, thanks, Steve. And also too, I don't know if they still do it, but they used to have discounts if you bought multiple memberships. So I think at one stage when they were transferring from or transferring to the cloud. So they used to have software you had to load on your computer. Now it's all online. They offered a 5-year membership, and it was only about $1,100 or $1,200 a year to join there and take out the 5-year membership.
Yeah, well, they did that at the conference too. I only quoted the 1-year price, but they did the same discount on the 2, 3, 5-year price as well. So yeah, it was a significant saving, which free money, I suppose.
Yeah.
Are you going to disclose that you're now a high-ranking member officially?
Well, I'm not yet, so nothing to disclose yet, mate.
Oh,
no, I've been nominated for the board, which just is probably because I'm too vocal and the only one that speaks up or something. But
great opportunity to put in a plug for QAV.
I would be. I mean, I think I already mentioned to you. I think Tony would be a phenomenal speaker at one of the events, and there's a lot of people there that need QAV in my experience. So if you're feeling like becoming even more of a rock star, mate, I'm sure there'll be a slot for you at one of those meetings.
Yeah, great, sure, thanks.
Yeah, just one quick question I had when you were talking about Accent One. Knowing that you've been reviewing it and kind of talked about it lately. If we're reviewing the numbers now, like their last reporting is the December half, and would you factor in at all what you kind of know about how the June half's going to look that could be, or is known to be substantially different in the numbers from the December half? Because the CEO came out a couple of weeks ago and said, our revenue's running at 50% of what it normally does, and we don't expect it to improve to anywhere near normal until at least October. So is that something where you would consider, holding off because there's, pretty much a guaranteed significant downturn in the numbers for the June half when they get reported in a few months' time?
Yeah, good point. I would, and what I'm looking for in that kind of situation, and Stock Doctor's having a bit of a hissy fit at the moment, is to go to the announcements and what's going on here? Anyway, I don't know if you can still see it.
This was an interview in the AFR. I don't know if it was actually a disclosed announcement or not, but it was an interview in the AFR last week where he just came out. Agostinelli's his name, and he came out and basically said, we're really happy because we're back to 50% of normal, but we don't expect to be normal until at least October. And when a CEO's not talking it up, you kind of wonder whether it might be even worse than that. Who knows again? But I just wondered with that case going, all right, well, do we really want to use the December numbers, or do we wait for another few months to get and then maybe the first half numbers aren't right because the second half's going to be better. I don't know. Like, how would you do that?
Yeah. So the first thing I looked at when I was doing Accent One was to look at what their announcements were, and they actually did a capital raising from memory, and they had to come out with all those kinds of forward disclosures then. And of course, if the CEO is out in the market making forecasts like that, they've got to announce it to the market generally as well. So what I'd be looking at in particular is whether the forward EPS had been discounted in Stock Doctor. And I just can't get Stock Doctor up at the moment. Something's going on. And anyway, I think it was.
Yeah, so I'm just pulling it up on mine, and yeah, you're right. The analysts have changed the revenue growth to down 16% and EPS down 25% for the June half.
Yeah.
So that's like a 35-point change from where the trend was in December.
Yeah, so you want to see that. If that hadn't have changed, then I wouldn't touch the figures. Since it changed, I'd still probably use them. But I'd be also almost, if we had a statement like we're going to be 50% down, I'd be halving the operating cash flow number.
Right. Okay.
Yeah, and using that as my basis for analysis. And then you got to ask yourself, we're 6 weeks from the end of the financial year, so they're going to come out in 6 weeks and at least tell us what their end of year numbers are going to look like. It'll take another month or two for them to come out and report them, but as soon as they know, they've got to announce it. So, I'd just be watching the announcements as they come out on something like that.
Okay.
But AX1 is a bit harder to do because it's going down, because the stores have been shut, because they've been coming out giving guidance. It's different to say the reject shop where they've come out and said, we've traded the whole way through and it's going okay. So that's kind of the reverse situation where it's a retailer and you can rely on their numbers.
Yeah, right.
And JB Hi-Fi said the same thing.
Yeah.
Yeah, Supercheap Auto were a bit more in the Accent One camp. They came out and said we had to shut down, and even though online's been doing really well, we're going to be much lower than we were last year.
Yeah, I wonder, with Brett Blundy resigning too, I wonder if there's something going on there, because he resigned from another board today too. He's on the Aventus Retail Fund. And he only kept Lavisa. So part of me wonders whether, you know, maybe there's something going on with Lavisa and he needs some cash for a capital raise, or who knows what. I don't know. But yeah, interesting that he resigned from 2 boards in the one day, because he's a very long-term successful retailer, right? Like he started Bras and Things, and he started Diva, which was the predecessor to Lavisa, and Sanity Music, and lots of well-known Aussie chains. So you would think he'd be a loss to that board if there's not something else going on with all of his retail experience.
Yeah, that's what I thought too. So I understand he hasn't sold his shareholding, so he's still got about 18% of the shares, but
okay,
he's resigned from the board. So whether he's just deciding to retire a bit, I'm not sure. It didn't come out and say it.
Maybe. Yeah, I mean, he's probably a billionaire, so maybe he doesn't need to work anymore.
There's certainly no longer a founder with a large shareholding on that board.
Right.
Yeah.
Well, my cigar is down to a nub. I think that's my signal that it's time to wrap this up, and my battery's going flat on my laptop as well. Thank you, everybody. Thank you, Tony. Thank you, Ball Boys. We might do this again next month.
All right.
Thank you, guys. Thank you.
Thank you.
Thanks very much, guys. Much appreciated.
Everyone.
Bye.
Cheers.
Yeah, thanks a lot.
Bye.